So a lot of trading advice that I see is incorrect. It doesn't show you or tell you what your true objective is. People are too focused on systems and basic if this then that sort of approaches. But if you really truly understand trading, then it will become obvious for you. It's like a light bulb moment suddenly opens up in front of you as to why trading is profitable and really what the best way is to do it. And that's what I'm going to explain in this video. I've been successfully betting and trading for over 2 decades. If you want more videos like this and you want me to describe more of what I do, then give us a like. If you want to talk to like-minded people, visit the Betangel forum where you can do exactly that, but also visit our website where you can download a free trial of Betangel. So when we're actively trading, people often seem to struggle to separate and differentiate the difference between trading and betting. But for me, it's very clear and obvious. If we're betting in a market, then we need to find value to make money in the longer term. The price is here. At the end of this particular event, it will end up over here somewhere, either in favour or against what you're betting. And the only way that you can profit in the long term from that is by finding value, by identifying that the market is mispriced, and then that will come out because obviously you'll win more frequently than you would expect, given the odds, and all of that sort of stuff. I think that makes fairly obvious sense. And when you look at a football match, for example, you know, if you back or lay under 2.5 goals, then obviously the number of goals within the match is going to determine whether that's profitable in the longer term. And in order to be profitable, you have to find value. And the same in tennis, in horse racing, in every sport that you can possibly think of. But from a trading perspective, that is not your objective at all. You don't have to find value in order to be able to profit in the longer term. It's all to do with the way that the market works and fundamentally what your key objective is within that market. And to better understand that, we should have a look at the stock market, because that actually neatly encapsulates exactly the difference between value and between a trading position. So let's have a quick appraisal of that. So the reason that we're going to look at a financial market is because it's very easy for me to actually be able to separate what this sort of value and trading opportunities, because if we were betting and looking for value, that's a very different thing from what we're doing when we're trying to trade. And I invested in a company recently, and the reason that I invested in them is I looked at the fundamentals. All of those fundamentals seem to stack up pretty well for me, and I'm pretty sure that the price is out of kilter with not only where the fundamentals are, but where they're likely to be over the next 5 years or so. I can't predict exactly what price they will be, but I just know that based upon those fundamentals, the amount of money that's going to be reinvested in the business or distributed to shareholders, that's going to very likely to produce a payoff for me over the next few years. However, one thing that I cannot do is tell you what's going to happen to this stock price in the next week, month, or 6 months, or maybe even the next year, because the problem is that longer term, all of those fundamentals will compound together to produce value and a payoff at some particular point in time. But over the short term, I can't really tell how the sentiment is going to go. So we have 2 different approaches here. I'm essentially placing a value bet on this company, which is going to pay off in a few years' time. But the shorter and shorter you get in terms of timescales, the more noisier the market becomes. So I may go down 5-10% on this position before it starts to mature and produce a payoff for me. But I can't predict what's going to happen on that very, very short term basis. But I know longer term, based upon all my experience in the market, that it does represent value, and therefore I'm very likely to get a payoff in the longer term. Doesn't mean that I will, but it's very likely that that situation will occur. And you find the same in every market. Over the long term, a market has to represent core fundamental values. It has to reflect the true intrinsic value of the business or the position that you're taking. And the longer you're in the market, the more chance you have of that occurring. But the shorter you look at, the noisier the market becomes and the harder it is to predict exactly what's going to happen next. But fundamentally speaking, that's exactly what the opportunity is when you're trading. So if you're trading properly, you're basically getting in at some point, you're getting out at another point. And if you're doing some sports trading, some Betfair trading, you want to hedge that position. You're basically making your position outcome independent. And that's an important part of the process, because if your overall position is dependent upon the outcome of the underlying sports event, then you're taking risk on the outcome of that particular event, and essentially you're betting on value. Okay, you may have captured some potential profit there, but you're making it dependent upon the outcome of that particular event. And this is why you always see me hedge. Whatever position that I have to hedge it, because that's the process. I'm not looking to profit on the outcome of that particular event. I want my trading profit to be outcome independent. That is exactly what I'm trying to achieve. But why am I trying to achieve that? Well, if we look over the longer term, you're basically saying that capturing value is a good way of making money, but over the very short term, the market is going to move around all over the place. The market starts at a price up here, it finishes at a price down here. Both those prices are probably correct at that exact moment in time. However, they don't represent the trading opportunity, because in between those 2 points, the market is going to move around all over the place, and that is what presents your opportunity for you. When you're actively trading, what you're effectively doing is you're trying to be on the other side of that volatility. And this is where one of the big problems comes when people try and trade for the first time, is they don't realize that that is their objective. What they do is they sort of think, the price is going up. No, in fact, it's going down. No, it's going. And the market bullies them. This is what I say to people when I first see them attempting to trade, is the market is bullying you. And what your objective is when you're actively trading is not to be taken out by that volatility, by the price movements that you see. You want to be effectively on the other side of it. You want to sell that volatility effectively. You want to sell that uncertainty. Your role within the market is basically to take a price and then sell it back into the market at something that's advantageous to you. But fundamentally speaking, what you're doing is, when the market's chaotic and the price is moving around all over the place, effectively what you're trying to do is to be on the other side of that. You want to be in the market when the price is too high or too low. You're looking to take advantage of that, and then you sell it back to the market when the market has calmed down a little. That's in essence what you're trying to do when you actively trade. So the trading process is pretty simple. You open a trade, you close a trade, and then you hedge that trade, because hedging the position, cashing out, greening, whatever you want to call it, makes your trade outcome independent. You're not placing a bet directly or indirectly. You're in the market, you're out of the market, you've taken a little bit of profit from it, and then you move on. This is why you see me always hedge positions, even when it seems obvious what is likely to happen in the underlying sports event. But underlying that simple process is the way that you would typically be able to make money from that noisiness that you see within the market. If you're active within the market and you're approaching the trading process correctly, then you can exploit that noise that you see within the market. And you're thinking, well, how is that possible? When we go into a trade, what you're trying to do is you're going in with a fixed stake or a maximum stake that you're going to use. So you're sort of thinking, well, on this particular market, I'm going to use a stake of £100. And if we actively trade something, say with a tick increment of 10%, what you're effectively doing is you're not risking that £100 on the trade. You're actually only ever going to risk whatever the price movement is within that particular trade. So we put £100 into the market, we take £100 out with a 10% profit, boom, we've made our profit. But what you should do at that point is not hedge. You should basically perhaps look for another opportunity within the market, or looking to maximize your potential within the market somehow. So that could involve repeating that trade again. But when you do this again, you use the same stake. You use £100. But of course, we've already got a 10% profit in the market, so we're not really using £100. We're only really using £90. So if we complete that trade again, we get another £10. And then our next position in the market is still a £100 stake, but we're effectively only risking £80 of that initial £100, because we've had two trades go through the market that have netted us a £10 profit. So if you structure your trade in this way, that's exactly the way that you would exploit that noise within the market. The market goes up, the market goes down, you're in the middle of that noise, and you're taking money out of the market effectively. And this is where people who don't trade or don't fully understand trading get things wrong, because very often you'll see me post up a giant P&L. Well, I say a giant, it's certainly in terms of turnover, it's a big number. You could see me trading £4,000 or £5,000 or more through the market, especially at bigger meetings. But I've never actually risked that. I've seen people sort of give me a prod every now and again saying, oh, there's no way you're going to catch me risking 5,000 for 100. Why don't you just have a bet? But that completely ignores what the trading process is, because that £5,000 or whatever amount it is, I'll bring up a screenshot and an example for you, is very, very rarely is that actually the amount of money that I used in the market. you get this thing called instant settlement when you're trading on Betfair. And basically, if we put £100 in the market, we take £100 out, that money is available for me to use again. And as I've just explained, I will do that as many times as I can. So if I manage to trade it 10 times through the market, that would have effectively given me a turnover of £1,000, but I've only ever used a stake of £100 to do that. So the net profit that I get at the end of that particular trading period is a reflection on the stake and not the turnover. So as a consequence, you can actually do very large amounts of turnover, but your return on the stake that you used can be spectacularly high, and it's nothing like as risky as a lot of people would make out or imply if they've never actually traded properly. But also think about it, what we're actually doing in there is by hopping in and out of the market on a regular basis. The market's doing this all over the place. We're jumping in and out and using the same stake. We are absolutely exploiting that noise that you see within the market. That's exactly the way that you want to be. You want to be on the other side of that volatility and that noise. Other people can be backing and laying and doing whatever they want within the market, but as long as the market moves, that opportunity will always be there. So when I was trading today, I set up a simplified ladder next to my standard ladder, and I just popped some orders into the market on a number of races. This is one of them, and you can see what I'm doing here is I'm putting an order in the market. Betangel is offsetting that for me and getting that matched, and I'm just exploiting that noise that we see in the last couple of minutes of a race to be able to create the profit. I'm using £10 stakes. Sometimes my net stake creeps up to 20, but that's just because I'm expecting the order to fill, so I'm just moving the new order in slightly ahead of that in anticipation that it's about to fill. But fundamentally speaking, I'm restricting the stakes to £10, and when we finish this trade, if you look at the overall result that we get, you can see that I put many multiples of that to trade through. So my overall turnover in this market is high, but the overall risk that I was taking was very, very small, because that total trade value was just made up of loads of £10 trades. And, you know, all we're doing is exploiting the noise within the market. We're not doing anything else particularly clever here. And I repeated this on a number of races over the card around this particular time of the day, just to show you that you could replicate this in a number of different ways on a number of different races. Now, on this example, and probably down to a bit of experience, I didn't actually lose on any of these races. You may find that you get a slightly different result, but fundamentally, hopefully what you can see here is that just by popping these little orders into the market, we're exploiting that sort of ever so subtle movement that we see around this period of the race. So your true objective within the market is not to be the best person ever pricing the market, to somehow predict the future or any of those, or to follow some amazing system that you've developed by backtesting 4,000 years worth of data. No, your objective when you're trading is to exploit that volatility. People are backing and laying for a whole number of different reasons. Over the longer term, when you're actively betting, that has to represent value. The outcome of the event will determine whether you get a particular payoff. But over the short term, the market becomes very noisy and the price will move in and out and it will fluctuate fairly wildly. And if you're trading properly, you are sitting on the other side of that. That's fundamentally what you're trying to do when you're trading. You're going into the market with a fixed stake, you're trying to capture a little bit of that volatility, then you're taking that stake out of the market. You may want to repeat that. If you repeat that many times over, then that works better and better within your favor. So over the course of a football match, a tennis match, I will actively trade with a fixed stake as many times as I can, because each time I use that fixed stake, it becomes available for me to use again, and I can repeat the same process. Slightly different when we're trading pre-off horse racing, but the fundamentals are fairly similar as well. And then when I've finished on each one of these at the position where I no longer want to trade, I just hedge my position so that it becomes outcome independent. What we're effectively doing there is we're selling volatility, we're selling the noise within the market, the differential. As long as people have a difference of opinion in terms of what price they want to back or lay at, that opportunity will always be there. And your role as a trader fundamentally is to exploit it. If you do that and you're very focused on that particular method rather than some sort of crazy system, then there's absolutely no reason why you shouldn't be able to make money when you're trading.